Hi everyone, welcome back to DG Tutorials. Get your pens and notebooks and let's dive right in. Today, we are talking about bonds. Imagine loaning money to the government or a company. This is essentially what happens when you invest in bonds. They promise to pay you back on a specific date, known as the maturity date. In the meantime, they also pay you regular interest payments, which are often referred to as coupon payments. This is the basic idea behind bonds. They are essentially a form of debt investment. A bond is a fixed income investment that represents a loan you make to an issuer. Bonds are like IOUs but with a formal structure. When you buy a bond, you are lending money to the issuer, which could be a government, municipality, or corporation. Governments use bonds to fund public projects, such as building infrastructure like bridges, roads, and schools. Companies use them to expand their operations, invest in new projects, or even refinance existing debt. Bonds are considered less risky than stocks because they offer more predictable returns and are less volatile. This makes them attractive to conservative investors who are looking for stability and lower risk in their investment portfolios. Bonds can provide a steady stream of income through their regular interest payments, making them a reliable source of cash flow. They can also help diversify your investment portfolio, reducing overall risk by balancing more volatile investments like stocks. When you buy a bond, you are essentially making a loan to the bond issuer. The issuer, which can be a government entity or a corporation, is borrowing your money. Governments issue bonds to fund public projects, while corporations issue bonds to raise capital for business operations or expansion. In return for your investment, the issuer promises to pay you back the principal amount of the bond on a specific date, known as the maturity date. This maturity date can range from a few months to several decades depending on the bond. In addition to repaying the principal, the issuer also makes regular interest payments to you, which are known as coupon payments. These coupon payments are typically made semi-annually, but can also be made annually or at other intervals. The interest rate on a bond, referred to as the coupon rate, is determined at the time the bond is issued. At the bond's maturity, you will receive your original principal back, along with the final interest payment. For example, if you buy a $1,000 bond with a maturity of 10 years, you will receive $1,000 back in 10 years. During those 10 years, you will have received regular interest payments, which can provide a steady income stream. Bonds are considered a relatively safe investment, especially those issued by stable governments, making them a popular choice for conservative investors. There are many different types of bonds available to investors. Two of the most common types are government bonds and corporate bonds. Government bonds are issued by the government. They are considered to be very safe investments. Corporate bonds are issued by companies. They typically offer higher interest rates than government bonds. Corporate bonds are considered to be riskier than government bonds. This is because companies can go bankrupt. Governments are much less likely to go bankrupt. Section 4. Risks associated with bonds. While bonds are generally considered to be less risky than stocks, they are not without risk. Investors often turn to bonds for stability and predictable returns, but it's crucial to understand the potential pitfalls. One significant risk associated with bonds is credit risk. This is the risk that the bond issuer may fail to make the required payments. Credit risk is the risk that the issuer will default on its debt obligations. This can happen if the issuer faces financial difficulties or bankruptcy. Another risk associated with bonds is interest rate risk. This risk arises from fluctuations in interest rates in the broader economy. When interest rates rise, bond prices generally fall. This inverse relationship can impact the value of your bond investments. This is because investors can buy new bonds with higher interest rates, making older bonds with lower rates less appealing. This makes existing bonds less attractive. Understanding these risks can help you make more informed investment decisions and better manage your portfolio. Section 5. Bond taxation in Canada. In Canada, interest income from bonds is taxed as ordinary income. This means that it is taxed at your marginal tax rate. Capital gains from bonds are also taxed. Capital gains occur when you sell a bond for more than you paid for it. It's important to remember that taxes can impact your overall return on investment. Consider consulting with a financial advisor to understand the tax implications of investing in bonds. Bonds can be a valuable addition to any diversified investment portfolio. They can provide a steady stream of income. They can also help preserve capital. If you are looking for a relatively safe investment with the potential to generate income, bonds may be right for you.